In this video, I'm going to discuss some strategies for trading silver for gold. I think most of my viewers have a good sense that silver is very undervalued relative to gold by historical standards. And a lot of my viewers who are just starting out stacking precious metals probably can't really afford gold at the moment, so they're accumulating silver. And at some point they want to trade that gold for silver. And I'll talk about some strategies for how to pick good timing and how to diversify your timing a little bit, right? You don't want to be trading all of your silver for gold. Nobody will know where the equilibrium will hit, right? Nobody will know if things are overvalued or undervalued, at least in the short term. So how do we diversify some of those risks? So a little bit of history. Up until 1971, the ratio of gold to silver was relatively fixed. Nixon took us off of the gold standard, and over the last 5 decades, gold and silver have both lost a lot of real value, right? As in what they can actually buy in the real world, because there's no monetary demand for gold and silver, right? There's a lot of industrial demand that has replaced that over the last 50 years, right? 50 years ago, a computer like this would have cost probably billions of dollars, right? And it would take up a whole lot more space, right? And now everybody has one, so a lot of industrial demand has replaced the monetary demand. Otherwise, gold and silver would be even cheaper than they already are, right? 1980, the Hunt brothers tried to basically remonetize gold and silver, right? Bring the monetary demand back into gold and silver. And as a result, the ratio of gold to silver fell to a much more normal 15 or so ounces of silver to 1 ounce of gold, right? But obviously, nobody knows where that is. Nobody knows how far that was going to shoot. So how do we strategize how we trade silver for gold to capture most of those gains and minimizing our risk? Well, if you have any sort of long-term investments, you're probably familiar with dollar cost averaging, right? The idea is that you take some amount of dollars per month or per whatever time interval you want to use, and you buy whatever investment it is, right? So in this example, we're going to invest $300 every month into shares of a company. When the shares are $30 a share, you're going to buy 10 shares. Next month they crash to $10 a share, you're going to buy 30 shares, right? Now what's the average of 30 and 10? Well, it's a trick question. You're buying more shares when it was $10 an ounce. So by the end of February, you have 40 shares, but you've only paid $600, right? 300 plus 300, right? So you paid an average of $15 a share. Now by March, let's say the stocks bounce back to 20. Even though overall the stocks are down, you are up. See, when people hear that I started buying silver during the Great Recession, last year silver was $12 an ounce, they think I've lost money, but I've actually been up because of the magic of dollar cost averaging, even though silver was down most of that time. That's the magic of dollar cost averaging. I bought a whole lot more silver when it was $11 an ounce in 2016, if I remember correctly. I distinctly remember that time because it made everything seem so much more expensive, right? I didn't want to go see my girlfriend. I had a girlfriend in Rochester, New York at the time, because the flight seemed so much more expensive. I had to give up so much silver to go see my girlfriend, which is nice because it forced me to meet locals here in Seattle. I almost didn't want to go to the computer game conference, but then I realized, that's it's important for my career, which is what allows me to buy silver in the first place, right? I almost didn't want to do anything else, right? I did end up going on a vacation, but I went to Warsaw because the cost of living there is a lot cheaper. But it was still pretty expensive relative to all the silver that I had to give up to make that trip. But my mental health is important too. That's the magic of dollar cost averaging. Now, how does that relate to trading silver for gold? Well, when you trade silver for gold, it's almost like you're buying gold using your ounces of silver as a form of currency, right? So what you have to do is silver cost average, right? Let's do an example. You have 10,000 ounces of silver that you want to trade for gold, right? You're sitting on 10,000 ounces of silver. Maybe you're still accumulating more silver, but you notice from the ratio that it's time to trade for gold. So you pick let's say it's a 5-year window that you want to do this over. So you trade 167 ounces of silver for gold each month at whatever ratio it is at the time, right? Now, it's a little bit trickier than dollar cost averaging, right? Because most people have a relatively fixed income in terms of how many dollars they make every month, right? Few people make X ounces of silver a month, right? Unless you're a silver miner, right? Unless you own a silver mine, most people don't make X ounces of silver a month, right? They have X ounces of silver that they want to turn into gold at some point, right? Or they have other things that... The same applies if you have platinum, palladium. Actually, trading palladium for gold is not a bad idea right now. I would trade it for platinum. The same principles will apply, right? You pick a time window and you average it out using your silver cost averaging or palladium cost averaging, which is what I'm doing right now. Let's do an example. It's January of 1977, and you realize that the ratios are going in favor of gold. So over the next 5 years until January of 1982, you want to trade your hoard of silver, 10,000 ounces of silver, for gold. And you're going to trade equal amounts on the 1st of every month. I did this with Excel. So on January 31st of 1977, you're going to trade 160 some ounces of silver, and you're going to get back 5.59 ounces of gold. And you do this every month for 5 years. Now at the end of 5 years, you will total... Did I write down the total somewhere? I forgot to write down the total. But your overall ratio is going to be about 32.52 ounces of silver that you paid for the ounce of gold. Now look at that table though. Most months, practically every month, except for 6 months between, during the Hunt Brothers saga, it was going to be more than 29, and it was over 40 for nearly a year. And the reason that you paid such a low price is, again, the magic of dollar cost, in this case silver cost averaging, right? Nice thing about that is you can feel free to go see your girlfriend, right? Because you're not using your income to do this anymore, right? I'll let you think about that. I think it was a blessing in disguise. I really do. There were a lot of things in Seattle that I didn't think about until that year when I realized that all the opportunity costs were very different. And so I had a very nice year. Just like the quarantine last year, right? There's always a silver lining to all of this, right? Now, the rebuttal I'm going to hear is, why not just sell? Because gold was down between the 80s and 90s as well. You got to remember what else was happening in the 80s and 90s. There was a lot of capital flight from the rest of the world. We had the fall of the Soviet Union, 1989, obviously. Mexican debt crisis was the mid-90s. And Southeast Asian crisis, 1997. I remember that time because my family and I traveled to Taiwan in 1998, and we commented on how cheap it was because of the crisis. Thanks for watching.